Welcome to the Bigger Cash Flow podcast, where we interview business owners and real estate investors that share tips and tricks on how to grow your cash flow and reach financial freedom.
What's up, you guys? Welcome to another exciting episode of the Bigger Cash Flow podcast. Today we have an exciting interview with Daniel Godbout. Daniel is an out-of-state real estate investor working full-time as an IT director for Sony PlayStation. In 2 years and at 33, Daniel acquired 10 buy-and-hold rentals across 3 states. He invested in multiple crowd-funded deals and in a tech startup. He currently lives in San Diego, California with his wife and 1-year-old son. Welcome to the show, Daniel.
Thanks, Bo. Yeah, glad to be here. Thanks, man.
All right. So let's just dive right in. And can you tell our listeners a little bit more about yourself, a glimpse into your personal life and what you're doing to create cash flow?
Yeah. Okay, so you covered some of the basics. I'm originally from Minnesota, and I do a little bit of investing there now. I grew up in the LA area. I spent some time in Florida, came back to San Diego. So here I am. I work for PlayStation now. I've been in the IT industry since really I entered the job market, so very beginning. And yeah, I've been investing in real estate, primarily buy and hold for the last couple of years. Before that, dabbled in some miscellaneous investments, just individual stocks in some other areas. But I found that I love real estate, and I've definitely wanting to expand my portfolio, still learning. I feel like I've been pretty active and doing pretty well with it, so I want to keep that going.
And we met up for dinner a couple times, and you're a very analytical guy, very smart. Out of the multiple asset classes, what really attracted you to real estate, and how did you go through that decision-making process?
I would say it was a process of elimination. I didn't start with real estate. I didn't have any prior experience. A lot of people have stories where they had relatives or parents or someone who was close to it, or somehow they accidentally landed in real estate investing. And that wasn't the case for me. I had started maxing out my 401k. I had some minor success with individual stocks, and I just felt like I was hitting a wall, and reading a lot, listening to a lot of podcasts and different books, and yeah, I found that the math worked well. I was having a lot more fun learning about it, and I stumbled on some pretty good resources that I felt could help me move things forward in real estate.
Can you tell us a little bit about those resources, that you used?
Yeah, couple books. Like one of them is Gary Keller's. I think it's the Millionaire Real Estate Investor. I thought was fantastic. It's one of the best books that I've read in that space. Bigger Pockets was a great podcast. I still follow that. And then I'd say where really things started to take off was when I started going to some of the real estate meetups, and not necessarily the like full RIA meetings. Some of I think they vary in size and scope, and there's a lot of people there. But even some of the casual small ones, that's where I met yourself, and I found those to be pretty valuable for me.
I love how you said Gary Keller's Millionaire Real Estate Investor, because a lot of people just say, Rich Dad, Poor Dad, or a couple other real estate books, but that book is also my favorite. That's the first book that I read after, diving into real estate investing. And he kind of divides his book into 3 parts: Think a Million, Make a Million, and Owning a Million. So obviously, a lot of these self-help and business books talk about how it starts all in your mindset and how you have to believe that you can instead of the scarcity mindset, which we talk about in episode 3, I believe. Go check that out, guys. But yeah, I think that's a great book. I think we're all in the process of kind of growing our million or millions. And, later in phase 3, he talks about how you can own it, how you can prune the bad fruit, and just become like a real business owner in your portfolio and in your life. So yeah, that's a great book.
So Daniel, can you tell us a little bit about how you got into your first deal? Was there a mentor or a person or a group that introduced you to your very first deal in your first market?
I was going down the path of investing in Minnesota, and I thought, well, I have roots in Minnesota. I knew some people who potentially could help out in that space. I wouldn't say I had a mentor. I did a lot of uh, the startup on my own. But to get things going, I really started picking up the phone, and I would definitely recommend that to a lot of people who are trying to figure out what their next move is. Is as soon as you start talking to a real estate agent or you start looking at properties, I think things start to really accelerate for people. So that's how it worked for me. So I looked at purchasing and I put an offer on a property in Minnesota, small town, too small, and I'd say that was definitely not. It wasn't a great deal. It wasn't a good deal. I did avoid it, not by my own will, but because really the seller had some challenges, but that property had so many problems, and I found myself pushing through. But in any case, that was almost the first deal. That was the first offer I put on a property. After I really like the wind was taken out of my sail with that property, I was pretty discouraged, honestly. So I took a step back, and I did go to some of those real estate meetups, and one of them happened to be hosted by a turnkey provider. And I'd heard a lot of mixed things about turnkey providers, so I was suspicious of it. I should say, walking into it, but the owner and the other attendees, definitely put me at ease. So I investigated that further and ended up purchasing my first property in Memphis, Tennessee.
It's funny because I hear a lot of investors describe their researching process, and they talk about, oh, my Uncle Joe lives in Iowa, or Aunt Sandy lives in North Carolina, and I'm gonna invest there. Looking back, do you think that is the best way to look at markets, or knowing what you know now, would you approach it a little bit differently?
Yeah, well, Minnesota in general is like a really challenging state to do business in as a outside real estate investor. So I think in general people should take a look at the market they're going into from a couple different angles, and just knowing what requirements each state and city has. Sometimes there's additional ordinances or inspections that you have to comply with. But like for example, in Minnesota, you do need like a broker's license to do a lot of things that you don't necessarily need in California. So just to rent out your property and list it, you do need a real estate agent broker to handle that kind of thing. So
So it's funny that you said your first deal was turnkey. I think all three of us did turnkey from the beginning. So can you talk a little bit about your experience with turnkey, what you learned, what are some of the pitfalls, but what are some of the advantages that you saw?
So the first turnkey property I bought, I wanted to keep risk minimized. I ended up going with a smaller, lower end property. I think it was 80,000, and I bought it sight unseen. For whatever reason, I did feel pretty confident buying it remotely and just working with the team who's helping me out. But I will say that coming from like San Diego or just California and in those markets, it's really hard to get a feel for the neighborhood in those areas when you're buying things unseen. So when I did eventually go and see the property after I owned it, I was pretty surprised by the neighborhood and taken back, by just the street view and everything else. And that's something I would, for some people, if they're a little more risk adverse, to make sure that they visit the locations, but not a requirement. Some of the other things I would say, tips for when you're purchasing something like that is to review what's being advertised. If appliances are supposed to be replaced, to verify those things are done after closing. I find that there's so much movement on these properties that there's not intentionally, but some things can be missed, and you want to go through with detail and follow up on these types of things. Make sure that stuff that's supposed to be covered in the warranty, when things break, they're covered and they actually are replaced.
There isn't like a set definition on neighborhood classes. Some people might deem an A class, B class, C class based on the prices of the property or the renters versus the owners or, school district or crime or whatnot. And an A class in the sandy beaches of San Diego might not translate equally into an A class in, let's say, Memphis or Little Rock, right?
Sure, sure. I wasn't totally expecting that, but yeah, for sure. I think you do hear the classes so investors investing in, if it's a property they just purchased tend to, I think if they bought in a C, they call it a B. If they bought in a B, they call it an A. They tend to embellish those things.
One of the pitfalls that you do have to watch out for, because Joe, you kind of asked about this, and Daniel, maybe you can share a little bit more about your tips and tricks, is that I was helping another investor underwrite a turnkey deal this week. And he had the pro forma, and then he looked at my webinar, and he did like a comparison. He normalized the, expenses and everything. And I was looking at the taxes, and it looked absurdly low. Like, I know that area, and it should be at least 800 to 1,000, and he put like 450 or something. So then, that's interesting. So I did a search on the tax county assessor's office, and it turns out that, there is a homestead exemption. So basically, if you're an owner occupant, you get like $300 off, or you get like 1% of the assessed value instead of 2% for a non-owner occupied. And then that drastically changed the tax amount for the year. So I told him to plug in the actual, because obviously he's not going to be an owner occupant 2,000 miles away. And that changed it from like a 13% return to like a 10% return. So now he's comparing these other turnkey properties more apples to apples, because when he first brought it to me, he's like, man, this is a home run. This is a winner. And then once you went through this exercise, he's like, he was kind of disappointed. So I kind of felt bad to kind of burst his bubble, but that's the truth, right? So whether they do it knowingly or unknowingly, there are things that you need to be aware of where they might try to maybe even use last year, 2017 values, and it's gone up 100 or 200 bucks this year. So things like that you got to watch out for. Anything else that you guys want to add?
Yeah, for me, Turnkey, I'm a huge fan for the beginner on your very first deal, but no more after that. Because I think the issue with Turnkey is that you have this false sense, especially as investors, that, they're going to take care of everything. And that's really not true. That you have to actually, vet them, vet the management team, vet their property manager. And also you have to keep an eye on what's going on with your property. I think all of us probably have some stories about how Turnkey failed us in terms of property management, or the rehab wasn't done properly, where we should have looked at the home inspection a little bit more carefully. So I think that's the biggest pitfall, is that it's great for a beginner to pull the trigger and get started, but at the same time, it's great to lose a lot of money if you're not looking at the deal carefully, or if you're not knowledgeable enough to figure out what some of the problems are, just like the tax issue that Bill just brought up. I think that's something that a lot of us kind of turned away. At least for me, I turned away from Turnkey after a few deals, realizing that that's not going to work out for me. So Daniel, can you talk about how you went from 1 to 10? Like, what was that transition like? Did you continue with Turnkey? Did you go in a different direction?
Yeah, I mean, initially starting out, I had some extra capital set aside, so it was really as fast as I could process the paperwork. I was moving on to the next set of properties, and I did stick to Turnkey. I felt like specifically to the provider I was working with, that things were working well. I agree with you that when you do have other avenues for buy and hold investing, or really for any type of real estate investing, cutting out the middleman, you'll definitely make a bit more. If you're limited on time and you can't be too active, I think that the right provider can work out. You do have to stay involved. I think there's also different types of turnkey properties, and right now at this point in the market, I do think it's more challenging to find the same types that I found even just 2 years ago.
Yeah.
My most recent purchase was a property that I did outside of Turnkey and had to renovate it, and that's by far one of the better investments that I've made, or at least to date so far. It looks that way. Yeah, I'd like to, my strategy has been to diversify in different ways. Even through Turnkey, it's not the same provider, same market. I've tried to go into a few different markets, different types of property classes. So I have, properties where, they're in A-class neighborhoods, and there's doctors living there, and they expect to stay there for a while. And then I have other properties where it seems like it's entry level property, and the tenants turn over on renewals. Yeah, so even in Little Rock, I mean, there's that's one of the markets I'm in, and there's different neighborhoods and markets within that you can invest in. And so I've tried to expose myself different ways that way. And then also that's where I'm leaning on crowdfunding, where I might not be comfortable in another market. And if I don't have that advantage or some kind of insight into a particular area, I'm trying to lean on those areas. And it can be crowdfunding or, a variety of other passive investment vehicles.
So when you went from 1 to 10, how did you finance your deals? Because, most of us, you start to run out of money pretty quickly when you're putting those 20% and then 25% down payments. Were there any special techniques you use to finance your deals?
I don't use any particular creative funding. It's really, in Minnesota, I've got a credit union that I'm using. I've worked with more of like an investment specialty bank, or like a department within a bigger bank that has investment focused team. And it's worked out well for me. It is generally a 20-25% down that I'm having to go through. So yeah, that is constraints, and yeah, I think if I want to go beyond this pace, absolutely, I have to look at partnering and looking at some more creative options. There were a couple deals where I had was able to get the owner on fourplex. I ended up not purchasing the property, but to agree to seller-based financing in those cases. So I got to learn a little bit more about what that would look like and some of the gotchas in there.
I think you really hit the nail on the head in terms of the conversation between, turnkey and doing it yourself, because I bought 4 turnkeys, I believe, out of my 11. And it definitely serves a purpose in terms of if you're a busy professional, you're making high income, you might not really have time to be active and go talk to wholesalers and brokers and do direct mail campaigns and whatnot. It is that idea of high risk, high reward. So if you are, in charge of the acquisition, the rehab, and the ARV, which is, getting it appraised, then of course you're going to have more equity built into it. It's your profit for all the work that you're doing. But a lot of the people that I've been talking to, I actually talked to husband and wife. They're making over $300,000 a year combined, and they just have no time. They actually wanted me to help and advise on how they can grow their portfolio. When I told them, you got to figure out your risk profile, you got to figure out what you want, what your lifestyle is, and then fit your investing methodology into what your goals are. Do you guys agree?
Yeah, totally.
No, I totally agree. But it is interesting that your last deal was more active. So that's what another pattern that I see with a lot of investors, for myself as well, is you start passive and then you start getting more interested and motivated, and then you do a little bit more creative financing, or some rehab or a BRRRR, or something totally different like Airbnb. That's what I've been transitioning into this past year. So I think that's an interesting path that a lot of investors take too. Is all 3 of us have W-2 jobs, but we're getting a little bit more and more active into our investing. So can you talk about that part too? You said your last deal might be your best deal ever. Can you talk a little bit about the numbers? Because I think a lot of people are interested in what kind of deals are happening like right now, this year, 2019.
the same broker that worked with me on the first deal that didn't go through, as he continued to work with me on looking at some other properties. And while I was in Minnesota going out there for a wedding, I made sure that I met with my broker for breakfast, and it must have been the cheapest breakfast I've ever bought for someone. But he was super appreciative. And after the breakfast, and it wasn't the purpose, it was really just check in, say hi, and he'd help me. So I wanted to take him out for breakfast. Any case, by the end of the breakfast, he had mentioned that he was doing a broker price opinion, a BPO, at a property that was just around the corner, and that if I had a few minutes, that I should swing by and check it out, and he thought it could be a good option for me. And I did. It was a reverse mortgage foreclosure that he was working with a bank on. He gave me a sneak preview of the property and just kind of what was entailed for it. He was going to make a recommendation to the bank, and he thought if they did approve that I should immediately put an offer on it. And I could tell just subjectively or kind of qualitatively figure out that it definitely was under market. It was at 160, and it really should have been selling for about 200,000. And
Right.
so I had an offer ready to go from the moment it was approved. So within minutes, it was sent to the bank and approved a couple days later. And so it didn't really have anything major wrong with it. It was really more of a cosmetic rehab, and I wanted to make sure some things were done with the property that made it more sustainable and just more attractive to tenants. For the neighborhood it was in, is a fantastic neighborhood, and I thought that the other thing is it's a property I would live in, so it gave me that. I think that gave me some other exit strategy or upside to it that other properties don't generally offer. So I thought that was an interesting angle. It could be a vacation house way down the road or something else like that. And so I put in about 25,000. I would say I didn't need to, but I wanted to take the time to do those things while I had the house vacant, and I was able to, because I have family in the area. I have a brother, my dad's in the area. They both have some contracting background, and they happen to have some free time over the late summer, fall time, and so they put a lot of the work in themselves, but they also coordinated other things on my behalf. And so it was still pretty passive from that standpoint. I was really, I was on the phone a lot, but they handled a lot of it, and they did an amazing job. Almost every contractor who worked on the property would ask if what I was renting it for, and I had the guy doing the carpeting was trying to get his son to apply to it and things like that before it was even listed. So that was a good sign that it was a good purchase.
Yeah, that's great. I mean, I think your story really kind of shows how important that networking and the relationships that you build is so important, because that guy, he's your guy that failed on the first deal, but you still, made a connection and continued that relationship and got you possibly your best deal out of your 10 properties.
Now that your son is one and you're doing all this great real estate stuff, do you have a different type of advice for our younger generation?
Yeah, I'd say, even with my younger siblings, I've got a brother who, I've been talking about real estate to from when he was in high school, and with my son, I totally expect to get him involved earlier. Not necessarily that he's going to be actively investing, but I think that there should be some awareness at like the potential with it, even in high school, because coming out of high school, you get opportunities to house hack, to kind of even in your living situation, to kind of look for those opportunities that I wish somebody told me. I lived in Florida for a bit, and I was in a perfect market to do a lot of active real estate investing myself. So I don't think it really mattered to have any level of capital at the time, and really just knowing the kind of situation I would be, or even paying attention to the real estate market. I feel like right now I'm watching parts of this real estate cycle, and I wish I had seen it like back in 2005. And I'd see some of the news headlines, and I paid attention to some extent, but not with a real estate investing mindset. And just being a little bit more mindful of that, I think you would spot the patterns a little bit more right now. And they're, I think a lot of people have talked about it for a while that maybe we're at the top of market, and but really the only people who seem to have a good sense of it are the ones who've seen it like an entire 10-year cycle, which seems to roughly be about what it is. And when you see that, you see what parts of real estate get really active like when the gates open and like we're at the bottom of the market, and then you see how it evolves and it becomes, goes from like a lot of buy and hold to flipping um, to more like active development, and I think you see a lot of that right now. And then now there's some warning signs. There's some things that are starting to buckle and to kind of you see pull back on. And it doesn't mean there's not opportunity. There totally is a lot of opportunities, but people need to be mindful of that and know where they're at in the market.
So can you tell us a little bit about your goals now that you hit 10? You said, right?
Yeah. Mm-hmm.
Yeah. So your Fannie and Freddie are all done.
Right.
So now you have, some, either you got to buy in cash or some other financing, commercial. What are your plans for the next 10?
Yeah, I think I took a little bit of a pause after the last renovation I did. I used some capital on that. I'm looking at I'd like to have improved my debt ratios a bit, and to make sure that I'm just in a good spot for taking advantage of bigger opportunities. So I want to make sure that I've got the capital on the side, and that's really my strategy right now. Also, some things are, there's home projects and cars that needed to be, or my wife's car needed to be replaced, and those types of things that I'm just paying attention to right now while real estate, or I should say mortgage rates are a bit higher. My strategy going forward is so bring that debt down a little bit over this next year, maybe pay off a property, and then I might be using portfolio loans a bit more, commercial loans if they make sense, buying cash, or even just partnering with others. You can also, I could potentially use my wife's W-2 to apply for a loan if we needed to go that route as well. So there's a few different options. And I think, and then also owner financing. I think there's always, as long as you're in a healthy spot overall, like there's a lot of different ways that you can go about it. I preferred to use the Fannie and Freddie loans as much as I could while I had them, but it's not a requirement.
Yeah. And actually, that's great that that's a quick tip that you just gave. If you're married and your spouse has a W-2 income, you can get up to 20 Fannie and Freddie loans, 10 each. But also, like you mentioned, the income to debt ratio can start to hit you once you start, on that road. So, but yeah, I've known friends or investors who have bought homes with their spouse and their name together, and that eliminated, 2 loans that they could have gotten, 1 extra loan. So that definitely is a great tip.
As we kind of tie this all together, on our show, not only do we talk about real estate, but we mostly talk about real estate because that's, Joe and I's passion, right? But we also interview business owners and other entrepreneurs. Can you speak to us a little bit about how creating your own portfolio on the side while having a, very successful, W-2 career, how has that kind of changed your outlook? Because for me, it's changed my life in terms of the weight of my shoulder. I feel like is much lighter. I don't feel like the pressure to climb up the corporate ladder as fast as I thought of 4 years ago. But I'm just curious on your thoughts on that.
Yeah, I mean, I think it was kind of unexpected, but it complements. I think they complement each other. There's skills that I acquired by looking at things from a real estate investments mindset, and taking more of that business ownership mindset into my corporate job. And then it also gives you you get access to a lot of people who are interested in real estate as well, and potential partnerships, and there's so many people are just interested in hearing about what you're working on. And then I'd say another advantage of having a corporate job while I'm doing all this is that I can take on a bit more risk. I don't have to have home runs or bulletproof plans every time. I have some flexibility in what I'm doing. and it gives me like a sense of empowerment when I'm at work. I'm there because I want to be there. I don't have to be at work, and I'm not at the point where I don't care about my salary at all. But it's definitely, it gives you a lot of freedom, honestly. And it's something that I've had the chance to talk to my boss about, that I'm at work because I want to be there, and even just personally, just having that mindset, I'm much happier coming into the office when I know that, like, at the end of the day, if I'm not happy with it, I don't have to be there. But anyways, yeah, I think they complement each other. They also make it a little bit tricky at times because, even doing things passively, there's a ton of paperwork, and you can let things get really disorganized and out of hand very quickly. And that, from filing your taxes and tracking all the expenses that you could potentially deduct, you'll start to lose track of those things, and you have to develop systems and become more efficient and organized. Um, but yeah, and then having a 1-year-old definitely doesn't make it easier. That's the third job. There's no income.
That's definitely a full-time job in of its own. Yeah.
That's awesome. I feel like, you've dropped so much good nuggets of information, especially for our listeners who are at their job, grinding away, following that traditional path. That is not the only way, right? It's not to say that, everybody should get into real estate and start buying, turnkey properties or start flipping homes or whatnot. But it is, very refreshing to hear investors who are just kicking butt at their W-2 job and just also growing their portfolio. So where can our listeners get in touch with you and learn more about you?
I think email me if anybody wants to talk or potentially meet up. My email is dan@godbout.ws. If meetup or a phone call or anything like that's an option, I'd be happy to provide some of the resources that I've used and go from there.
I'll have all of that information in our show notes, so please check it out at www.biggercashflow.com. Well, that wraps up the end of our show for this week. If you thought that was helpful, please do us a favor and leave us a review on iTunes. We'll see you right back here next week for another episode of the Bigger Cash Flow Podcast. Thank you for listening to the Bigger Cash Flow Podcast. Please remember that opinions of the guests are their own, and nothing on this show should be considered personal or professional advice. Please consult your tax, legal, or financial advisor for personal advice that fit your unique situation. See you next time.